right. Thank you so much for joining today's webinar related to student loan planning for medical professionals. I think, over the course of the last, 10 plus years working in the financial planning space, this is a topic I think that has especially come up related to medical professionals and managing student loans. I mean, typically when we think about it, as we're working with, medical professionals, there is usually going to be a significant sacrifice related to both time and money to develop your skill set or your craft. That really has an impact downstream on your career and really puts an emphasis on making optimal financial decisions as soon as possible. And because of those, that later start to earning years and the larger balances of student loans when you begin your career, it typically leads us to putting a major focus on this early in the planning process as we're working with medical professionals. So before we get started and we dive into the content, a little bit of background about myself. My name is Brian Walsh, and I lead the financial planning team here at SoFi. I am a certified financial planner, and really the team that I lead provides all of our members with complimentary access to financial planners to talk through, the ins and outs of their personal finances. And then we take these conversations, we identify trends and things like that, and then really present them more in scalable solutions, a webinar like this, along with kind of our house views and the things that we've learned having these conversations throughout the years. It's important to keep in mind, though, that even though I am a certified financial planner, nothing I talk about today should be looked at as financial advice. Think about it more as high-level education or guidance, things like that. Certainly, especially, I guess, when we start talking about student loan planning, because there are so many different options. There's so many different nuances. And I don't know enough about your personal circumstances, even when I start answering questions towards the tail end, to really get into that level of detail and provide specific advice. If you want that advice, feel free to schedule an appointment with one of our financial planners, and we can kind of go through that process. So today, I want to kind of hit on, first and foremost, how today is going to progress and what we're going to be talking about as the session goes on. But really, we're going to start with the basics and the building block first. I think before we start diving into, hey, what exactly could we consider doing with student loans, different pay down strategies, refinancing, whatever it may be, I think it's really important to understand the basics to make sure that we keep that in mind as we're developing a high level strategy. So really diving into federal student loans, private student loans, what are the differences and what are the key things that you should be aware of as you're looking at your current student loans. From there, we'll really kind of approach things from a high level. Looking at it from a 30,000-foot view on, what's going to be my overall approach as I start paying down my student loans. And, the interesting thing about this is this approach, number one, it should drive, what you actually do. Number two, it's, doesn't have to be overly complicated. I think the high level approach is relatively simple. And number three, it's going to change as your career progresses. Let's say when you go from, residency to attending or things like that. Then finally, we're going to hop into some strategies that align with that high level approach. So we'll pick out and we'll say, okay, here's the high level approach that you may be considering. Here's some specific strategies that might be beneficial or might be common based on that high level approach. And then we'll end it with some questions and answers before we wrap up. Perfect. So kicking things off with the basics and really thinking through this. And, I think this is arguably one of the more important slides that we're going to cover today, because I do think that understanding the difference between federal student loans and private student loans is absolutely critical as you start evaluating, how you're going to approach your student loan pay down. So looking at it, taking a step back, when you're looking at student loans, generally speaking, there's going to be two different types: federal student loans and private student loans. So federal student loans, these are going to be student loans that you took from the government. Think Stafford, direct subsidized, direct unsubsidized, things like that. With federal student loans, they're going to come with federal benefits. Deferment, forbearance, income-driven repayment are things that we commonly think of. But a perfect example of a federal benefit would be the impact of the CARES Act since last March, suspending payments and interest for an overwhelming majority of federal student loans that goes through the September of this year. That's a perfect example of a federal benefit. Also with federal student loans, there's certain loan forgiveness programs that you might qualify for that are going to vary depending on your career choice, where you work, things like that. So it's important to keep all those things in mind. And if you're going through your student loans, you're like, hey, what type of loans do I have? Where are my federal student loans? You could always leverage the National Student Loan Data System to understand your specific federal student loans. Then on the flip side, we have private student loans. And typically where we see private student loans come into play is with federal student loans, there's going to be a limit or a cap on how much federal student loans you can take out for your education. And, majority of the time that doesn't quite, fill the need for the total cost of education, especially in the medical profession. So typically we see private student loans kind of filling that gap where, let's say the education's here, federal student loans are here, those private student loans fill that gap. Private student loans, are different from, federal student loans in this fact that they're taken from a private lender. So think Wells Fargo, Discover, SoFi, etc. They don't come with federal benefits. So some private lenders may actually offer some benefits like forbearance and pausing payments and stuff like that. But it's important to keep in mind that they don't qualify for the federal benefits. Prime example, going back to the CARES Act that we talked about before, federal student loans, a majority of them had payments and interest suspended from, last March, through September of this year. Private student loans, that wasn't the case because that was a federal benefit and private student loans don't have federal benefits. Also don't qualify for federal loan forgiveness programs, whether it be current or potential ones in the future. I know we get asked about that a bunch. So I think those things are really key to keep in mind. The other thing is with private student loans, those are typically, when you look at those, when you apply for those, they're going to look at, income, credit profile, whatever it may be. So interest rates, are going to be, going to vary across private student loans. So that's also a factor to keep in mind as you're, evaluating what you currently have in place right now. Kind of piggybacking off this federal and private student loans conversation, there's also two similar yet very different concepts that we come across as we're working on student loan planning with individuals that also comes back to this federal versus private student loans type of conversation. And those concepts are consolidation and refinancing. I can't even count the number of times that people kind of use these terms interchangeably. And that's a little bit worrisome as I go through this because they are two different things. So I want to make sure that as you look at your student loan picture, federal and private student loans, you're evaluating your options, that you understand these are two distinct things that would be done, and they have two different purposes. Not saying one's better or worse. It's all about, what you would be doing, why you'd be doing it, and making sure that you're making the right decision that you intend to make, not making, an accidental mistake. So let's start with federal, direct federal loan consolidation. So with that, essentially what you could do is you could merge multiple loans into one. Many times we interact with folks and it's not like they have one federal student loan and one private student loan. They have a bunch of federal student loans and a bunch of private student loans. So you can merge multiple loans into one, but it only applies to federal student loans. So you can merge multiple federal student loans into one federal student loan. The benefit here would be it could simplify your overall finances by taking, let's say, 12 payments, rolling it into one payment, so it could simplify your finances. Also, major benefit here is you would maintain your federal benefits. The downside here is, you're not really going to get a break on the interest rate or anything like that because it's merging those together. So essentially, you end up your direct federal loan consolidation would have the blended interest rate of the federal loans that you brought together. So consolidation, think about it, only federal, not going to lower your interest rate, bring things together, and you're going to maintain your federal benefits. So refinancing, somewhat similar concept, but very, very different. Important to keep that in mind. So the similar side of things is, with refinancing, you could merge multiple loans into one, which could then take it from a bunch of different monthly payments to one monthly payment to simplify your finances. Where it differs is the sense that, this is a brand new student loan, and you can merge, you can refinance both federal and private student loans. So it's not just federal, it could be both. So bring it together. Ideally, if you're refinancing, it has the possibility of looking at your income, your credit, among a bunch of other factors, and potentially could you reduce your interest rate, but you will not maintain your federal benefits on federal student loans that are refinanced. So that's the big one there. It's just keeping that in mind. Again, both could be so helpful as you're looking at different aspects of your student loan planning. Refinancing, you can merge a bunch together. It could be federal, it could be private, combination of the two. You're gonna have one monthly payment, simplified things. You could potentially lower your interest rate, but you will lose your federal benefits on your federal student loans. So that's the big difference between direct federal loan consolidation and refinancing. And then finally, before we move on to talking about the different approach, another very, very important concept that we end up working through with student loan planning, especially for medical professionals, is the different repayment options that are available for federal student loans. The repayment options for federal student loans are much broader and much more flexible than they are for private student loans. So with federal student loans, we will typically see, okay, you got the standard repayment option, which is essentially like you think about it like a normal debt. You say, hey, I'm going to repay this thing, over 10 years. That's, I got my interest rate and that's how my payment is determined. It's going to be that same payment amount during that 10-year period. At 10-year period, it's over. You also have some other income-driven repayment options that are available with federal student loans. So one of those would be Repay, or revised pay as you earn repayment plan. Another one would be Pay, which would be pay as you earn repayment plan. Another one would be IBR, or income-based repayment plan. And then another one would be ICR, which would be income contingent repayment plan. Now, unfortunately, the names are not the most descriptive things in the world, like how they actually work, how your payments determined, all that fun stuff. Like typically you can't tell that based on the name. And there, quite frankly, there's a lot of different nuances when it comes to these different repayment options with federal student loans. So it's really, really important that you work with a qualified professional and hash out your options and fully understand, because these different repayment options they're going to vary based on your income, your filing status, your family size, all sorts of different things that'll end up influencing these different payment amounts, both in the short term and in the long term. Generally speaking, income-driven repayment plans are designed to, have a monthly payment amount that's going to be, affordable, relatively affordable, I guess, depending on your definition of that, especially as you talk about larger balances, but relatively more affordable and, fitting into the budget. But as you start looking at these different options, it could actually, when you stretch it out and you have lower payments now, it could actually cost you more money over the long term. So it's really about balancing out and understanding, what those objectives are, and then aligning that approach to the objectives, which is really what we're going to dive into in the next section, which is, as we're looking at this, after understanding the basics, which is absolutely critical because it helps people make educated and informed decisions about where they currently stand and what their options are. The next step that we typically talk through is encouraging people, especially medical professionals, to take a step back and take a 30,000-foot view and say, hey, what really matters? And let's simplify this as much as possible. And just ask yourselves a simple question, like, do I want to minimize what I'm paying right now? Or do I want to minimize the total amount that I'm going to pay over the lifetime of the loans? And, a lot of times student loan planning gets super complicated, you get lost in the nuances and everything, but the high level approach can really boil down to that basic of a question. And as we're thinking about this question, number one, there's no right or wrong answer. Everyone's personal financial situation is going to be different. Some of you may choose, hey, I want to minimize what I'm paying right now. And because, maybe you have high expenses, or maybe your income is, a little bit strapped right now, or maybe you have other things going on in your finances, like that would be a perfectly, acceptable and an ideal type of solution for what you have going on in your finances right now. Others of you might say, hey, I want to minimize the total amount that I'm paying over the long term. I want to get after it because I don't want to pay a bunch of money in interest over the long term. And that's another, Great solution given your personal financial situation. Maybe you have more room in your cash flow. You're in a different financial position from a foundational perspective that we'll talk about later, all different other things. So I think it's just looking at that and saying like, hey, what's the most pressing thing for me from an objective perspective related to my student loans, and looking at it right now. So that's number one. Number two, we will typically see that this will change over time. A perfect example of this is, I was, talking with, a member who, she paid off her student loans, relatively quickly, like a lot of student loans in a quick period of time. But that doesn't mean that her entire pay down journey, she didn't even have the same approach during her entire pay down journey. She actually started off very, very early on related to residency, where cash flow was much more of an issue. And during that period of time, her focus and her objective was to minimize the amount that she paid right now. And that was, to fit everything in her cash flow and everything like that. But then as her career progressed and as her objectives changed, she switched gears. She's like, okay, now I'm in a different place related to cash flow, of things going on in my personal and financial life. Now my focus is on minimizing the amount that I'm going to pay over the lifetime. And it's going to be a much different approach. So it's taking a step back, thinking through what really matters to you related to your student loan paydowns, because we're going to talk through some different strategies that could apply to each one of these different objectives, depending on which one is what you want to focus on. So let's start with, for those of you who are like, hey, right now, given my current situation, my focus is going to be on my current payments. My focus is right now, it's going to be on minimizing the amount that I pay right now. Now, first things first, I think, there's reasons to minimize what you pay right now. But typically when you start looking and doing that and you say, hey, minimizing now, that means you're, generally speaking, it's very, very likely that you would end up paying more over the long term than if you, ended up putting more cash out of pocket right now. Totally fine, given that, it fits what you need and fits what you're focusing on. Just going into it with your eyes wide open, like there's no such thing as a free lunch. Like generally speaking, it's like you're either going to pay now or you'll pay in the future. This approach, you would minimize what you paid now, and over the long term, you could end up paying more money. So looking at different approaches that we typically explore related to student loans for people that want to focus on minimizing what they pay right now. We'll break this up into two different buckets with private student loans and federal student loans. So I guess with private student loans, typically the two levers that we explore here would be, as it relates to refinancing, could be potentially refinancing to lower interest rates, or refinancing to kind of stretch out and make it a longer repayment period. And both of those things, all else being equal, could reduce the amount of money that you would be paying in the present. So lower interest rate. So let's say, you have, a given balance and, you're going to pay it back over the course of 10-year repayment period or whatever it may be. And, you take your interest rate from, I don't know, just making up numbers here, not promising rates. That's going to be completely dependent on the situation. But let's say you take it from 5% to 4%. If you keep that same 10-year repayment period, all else being equal, your monthly payment would drop. So that could be a way to reduce your monthly payment over that period of time. Another option could be, lengthening that repayment period. So let's use that same example. So let's say we have, I don't know, 100 grand of private student loans. And we're looking at right now, we're paying 5% interest and it's a 10-year repayment period. Let's say, refinance that, we keep the interest rate the same, the balance is the same, but we stretch out that repayment period. So instead of 10 years, we stretch it out 15, 20 years, whatever it may be. Then that monthly payment would then go down, and that would accomplish what the objective would be here, which would be to minimizing the amount that would be paid right now. Again, with that option though, by stretching out that repayment period, keeping the interest rate the same, it would result in more interest being paid over the life of the loan. Next, we'll look at some possibilities related to federal student loans. Typically the one that we talk about here, granted refinancing could come into play. In theory, you could refinance federal student loans and look to have like maybe a longer repayment period or a lower interest rate, similar to what we talked about earlier with private student loans. But specifically sticking with the federal student loan kind of in that bucket, this is where we typically start looking at exploring different options with income-driven repayment options that we talked about previously, whereas, those different repayment options. And again, the repayment amount is really going to vary. It's not, it's not set in stone where it's going to be the same for everyone. That's why it's important to really dive into that, understand your options, go through those different scenarios, based on, let's say, your income, your family size, tax filing status, things like that, really understanding that to see what those options would be. So typically those are the types of things that we look into and kind of combining, mixing and matching, depending on the specific circumstances for folks that are focused on, minimizing the amount that they pay right now. On the flip side, we go to the other, approach or the other objective of minimizing the total amount that would be paid over the life of the loan. And with that objective in mind, let's take the same approach: private student loans and federal student loans. Private student loans, typically the types of things that we would explore would be lower interest rates and shorter repayment periods. Again, lower interest rates. We look at it and we say, okay, let's say we have, go to that same example, 10 years, and we got a 5% interest rate. Let's say if we refinance that, and we got a 4% interest rate over that same 10-year period, then, theoretically, then, we'd be paying less interest over that 10-year period than if it was, looking at, that 5% interest rate. Shorter repayment periods, you could accomplish this through refinancing. And let's say you refinance from that 10-year repayment period to, let's say, a 5-year repayment period. Maybe you could look at reducing your interest rate right along with that. But either way, you're paying more out of pocket right now because it's a shorter period, and it could save you money in interest costs and other costs over the lifetime of the loan. Federal student loans, I guess it's a similar type of situation. We typically look at, if we keep federal student loans, maybe making extra payments on those to shorten that repayment period. We could also look at refinancing federal student loans. Again, we'd lose federal benefits there if that happens. Looking at potentially lower interest rates with refinancing, maybe a combination of lower interest rates and a shorter repayment period to really kind of shorten that up and minimize the amount that we pay. Again, higher amounts being paid in the short term there, though. Also something, depending on your circumstances, where you work, things like that. This would be something where maybe loan forgiveness comes into play with federal student loans. But again, it's really important. That can get very complicated and very nuanced. It's important to understand your specific options and the specific requirements related to loan forgiveness, because that's something that you're banking on and planning on doing. If you have some technical issues or the administrative type stuff and it gets messed up, then it can really cost you some money. So really making sure that you go through that based on your personal circumstances and dive into the details in that situation. So up to this point, we've been talking about student loans. And I think student loan planning is extremely important, especially for medical professionals, because the amount of student loans and things like that. But the fact of the matter is, it really encouraged people to not look at their student loans in a silo. The fact is, personal finances are so much more broad than just one single aspect, even an aspect as important as student loans. And this ends up being a conversation that we typically have as we're working with people and they figure out, they're trying to think through, okay, maybe I want to be more aggressive with paying back my student loans. And the next question ends up being like, if I want to reduce the total amount that I pay and I want to be more aggressive, how aggressive should I be? And this is where we really try to balance that. It's about taking that balanced approach, because I think it's extremely valuable to take an aggressive approach, save money on interest, and be debt-free sooner. That can have financial and emotional benefits. But at the same time, we don't want people to neglect other critical aspects of their personal finances in pursuit of that. So we kind of came up with this framework that really guides, almost everything that we do related to financial planning at SoFi. And it goes step by step, and it says like, hey, from a pecking order, what are things that we should be focusing on, and when should we focus on it? And the high level idea here is like, we don't want to go out of order and skip steps, because if we skip steps, it could leave us exposed to potential risk and missed opportunities. So generally speaking, before getting extremely aggressive, paying down good debt, which we classify good debt as debt that has an interest rate less than 7%. Typically, student loans fall in this category of good debt. we encourage people to tackle other aspects, make sure other foundational items of their personal finances are shored up before getting too aggressive when it comes to good debt. Some of those items would be having enough cash on hand for an emergency. That's extremely important. Liquidity is extremely valuable. Things happen, and being forced to tap into a 401k loan or credit cards or personal loan or whatever it may be can have major ramifications on your personal finances if you don't have a proper emergency fund. So generally speaking, we look at a proper emergency fund being like 3 to 6 months worth of expenses, depending on how stable your income is, your family size, things like that. Also extremely important to take advantage of an employer match if you have one available. Not everyone has one available, but if you do, that's essentially free money. Taking full advantage of that can be very, very powerful over the long term. Another aspect that's especially important to the medical profession is income protection. So if you have people that rely on you, rely on your income, that would be life insurance. At a bare minimum for everyone, it'd be disability insurance, especially with your specialized profession. Typically, we not only look at disability insurance, but we look at the definition of disability because there's a different definition of disability between any occupation and own occupation, and our planners are more than happy to kind of talk through those differences and make sure you have the right type of coverage set up. But it's really important to protect your income. So that's such a valuable asset that you have. Another aspect would be bad debt. High interest debt like credit cards, personal loans, sometimes auto loans, things like that. That's generally speaking, that's more costly than student loans. So we'd want to tackle that before, getting very, very aggressive with student loans. And then finally, retirement. At the end of the day, when it comes to investing, time can either be your best friend or your worst enemy. And compounding growth can have a very big impact on your future ability to, have enough money to retire, especially given the income earning potential of medical professionals. We typically look at like 20 to 25% being saved for retirement as a baseline. Because, number one, higher income earners need to save more money to be able to replace their standard of living, because Social Security has a lower impact. And number two, generally speaking, you have a shorter working horizon than other professionals because it took you, you sacrificed those years to get into your profession. And on top of that, we do see people in the medical profession that may want to retire earlier due to burnout, bureaucracy, things like that, especially with what's been going on over the last year and a half. So keep all these different things in mind. It's not always going to be like a simple answer like, oh, I'm always just going to focus solely on student loans, or I'm never going to focus on student loans. It's about keeping those things in mind and taking that balanced, moderate type of approach related to kind of mixing and matching all the different aspects of your personal finance. Perfect. So now I want to transition to the questions and answers, because there's some great questions that were submitted throughout this experience, and we'll kind of go through there. Again, even though these are more personalized to you, especially even if you ask the question, not financial advice, just my response based on high-level education or guidance. And then we'll go from there, and we'll finish up some closing thoughts. Okay, first question, awesome question here. With federal student loans being in forbearance with no payments or interest, how do you justify refinancing at this point? Great question. You know what? To be honest with you, I think this is a tough answer, and it was a lot tougher of an answer before a couple of weeks ago. So number one, anytime you're considering refinancing federal student loans, especially right now with the suspension of payments and interest, you need to very, very closely consider the value of federal benefits before you refinance, because you will lose those. Same time though, we're in a relatively low interest rate environment. And, and if you think about large student loan balances, it's like, hey, a lower interest rate, let's say if it's even 0.5% lower or 1% lower, that could have potentially a big impact on the amount of money that you pay over the long term with big balances. So it's kind of trying to find that balancing act, right, between, relatively near historic lows in interest rates, the federal benefits, especially the suspension of payments and interest. Fortunately, I think my answer became a lot simpler as SoFi launched a new program called Snooze. And essentially what that does is it kind of combines the best of both worlds. Essentially what would happen is you would lock in your rates now, and have that opportunity, but the refinance wouldn't actually happen until after that period of September, October period. So it'll allow you to take advantage of that period of time in which, no payments and no interest from a federal loan perspective, with the idea of locking in interest rates now to provide that certainty of potentially kind of accelerate your plan over the long term. Again, that doesn't mean it's for everyone, case by case situation. I think that's a valuable benefit and an extremely valuable feature to a tool when it comes to student loan planning right now, with this kind of gap in between, when payments are going to kick back in. So I think exploring that option and really weighing the pros and cons of federal benefits, even beyond the current suspension of payments and interest. Next question. I just purchased a home and have become pretty debt heavy due to my home and my student loans. What are some different ways that I could reduce my debt? Yeah, so that's a great question. And I think, the simple answer is there's going to be a bunch of different things that you could try and you can implement. And all of them are going to take some time and they're going to take some discipline. So I think looking at your student loans first and foremost, I think looking at the different aspects of like, hey, am I focusing on, minimizing that payment or minimizing the amount of interest I'm paying based on everything else I have going on? Figuring out that approach with student loans. From some other aspects, I think especially if you're worried about your debt load, one area that could be impactful is to stop spending on a credit card. Research shows that when you buy something on a credit card versus using like a debit card or cash, just subconsciously, you're more likely to spend more money or accelerate your purchases. So that could be another option. Stop spending on your credit card, and it might reduce your spending and therefore reduce your debt. Also, you could look at tracking your expenses. Really getting in there with a fine-tooth comb and saying, hey, I got a lot going on with my finances, house, student loans, whatever. And looking at how much I have coming in, how much I have coming out, where's it going? And kind of refine that so that way you could find whatever surplus you have and put that to work, whether it be increasing your savings, paying down your debt quicker, whatever it may be. But I think those would be the places that I would start and look at kind of those areas of low-hanging fruit related to your debt load. Next question, can I combine student loans with a personal loan? No, you cannot combine student loans with a personal loan. Next question. If we refinance our student loan, would we be eligible for any relief that might come down? Yeah, another great question, something we get asked a lot. I talked about this a little bit earlier, but so if you have a federal student loan and you refinance it and you have a private student loan now, you lose federal benefits. And, one of those benefits could potentially be if there's any sort of loan forgiveness out there that's, being talked about in the media. So yeah, you would end up, not being able to take advantage of that. This becomes a tough one. I think this one goes back to, really evaluating these decisions and making for yourself, because, if we all had a time machine with a crystal ball, we could see, oh yeah, they're going to do this, they're going to do that, or whatever it may be, then, the answer is, always clear in hindsight. But as we're, making decisions with uncertainty, I think it's about weighing pros and cons. Number one, how confident are we going to be that, there is going to be forgiveness? Number two, how big is that forgiveness going to be? And how does that compare to my current student loan size? Number three, would that forgiveness apply to me? Or would it be, some sort of income tested, or, the limits on income or things like that? And do I make above that? I think you got to consider those factors before you make this decision. And, let's say you make the decision and, something else happens and it wasn't what you expected. And you may have some regrets, but at least go into it with your eyes wide open, knowing that, yeah, you wouldn't get forgiveness. Here's why I'm making that decision based on the amount I have, based on what's being discussed, on my income, on all those other things as we make that decision. All right. Next question. I refinanced as a medical resident. What would be the benefit of refinancing again at this point? Yeah, so I think when you look at your private student loans, at the end of the day, when people ask me like when's a good time to refinance my private student loans, like my answer is kind of simple, like early and often. Like I think if it benefits you, and you consider like fees and versus the benefits, then and you make an educated decision, then I think it'd be beneficial to do it multiple times. I'll speak from firsthand experience. I'm not a medical professional, but I refinanced my student loans multiple times. So I think what we typically encourage people to do is, number one, check on what your new rate would be using a soft credit pull. Soft credit pull is a great tool to have because essentially, it's not going to impact your credit. It allows you to see what your rate would be. And if that rate's going to be lower than what you're currently paying, you check it out and you say, okay, what are the fees? Like at SoFi, there's no fees, so that's pretty easy. So if you're like, hey, rates lower, no fees, then it could probably be a pretty straightforward decision. There could be some other things that complicate it, like maybe you're in the process of like buying a house or buying a car or something like that, where you don't want the hard credit inquiry, because you would have, when you actually apply for it, you would get that hard credit inquiry. But yeah, I think looking at what the rates are versus what the potential fees could be and comparing, and I don't think there's any problem when you consider that to refinancing multiple times to save yourself money. All right, next question. Does SoFi offer personal loans for debt consolidation? Yes, so SoFi has a personal loan product. And I would say the two most common reasons that we see members who we work with in financial planning conversations, I can't speak to the broader population, the two most common reasons are home improvement projects and debt consolidation. So to your point, we would see that typically with someone who, let's say they have some credit card debt. Credit card debt's expensive, high interest rates typically, which really impact the ability to pay it down and what those payments are. And it really just kind of, it's like a snowball type of effect. So we do see people have success with saying, hey, take that, I don't know, 50 grand of credit card debt, replace that with a $50,000 personal loan. Maybe the interest rate's lower, I have a defined payment period, and that could be beneficial. Big warning though, if you do that, please stop using your credit card. Unfortunately, I've worked with people who got a personal loan maybe 2 years ago, a year ago, whatever it may be, and they used it to get out of debt and consolidate their debt, but then they kept using their credit card. So then 2 years later, they had the personal loan and they had the credit card, and really put a cramp in their finances. So I think it could be a powerful tool if used correctly. We do offer it, but please make sure that you stop using the credit card until that's paid off, so that way you don't run the risk of having credit card debt and personal loan debt. Perfect. So that wraps us up for the questions. A couple things, some resources I wanted to close out on to make sure that you're aware of those. Number one, I talked about the SNOOS program. So essentially, right now, with federal student loans, you could lock in the rates now and then keep the CARES benefits, so you wouldn't have to make payment until October. So you could check that out, see what that looks like for you as you explore your options. I think, as I mentioned earlier, like this made this decision process from a financial planner perspective much simpler than as we were evaluating things for the last 6-12 months. So I think exploring that could be beneficial. Another thing is, a lot of times your situation is going to be more complex related to student loans, and quite frankly, every other aspect of your personal finances, being a medical professional. So as you have questions, you could chat with someone who can specifically answer those and know the ins and the outs with our healthcare hotline. So you can call that number. And then finally, the team that I lead, the financial planners. If you want to dive into your student loan planning, other aspects of your personal finances, you can schedule a complimentary appointment with our financial planners, going into the app or on the website and scheduling an appointment. Perfect. So I appreciate everyone joining today. Really, thank you for taking the time out of your day. Hopefully we had some clarity and some options, some things to think about as you're looking at paying down your student loans. Feel free to leverage those resources that I just hit on, and have a great evening and a great rest of the week. All right, thanks.